Wall Street saw many ups and downs in the last 3 months of 2018. The quarter concluded with bulls and bears vying for control of the market, which resulted in negative performance for all three primary indices. To the frustration of investors, the Federal Reserve sent conflicting signals about its plans. No real progress was made in resolving the U.S.-China trade war, and the Brexit appeared to reach a standstill. The price of oil dropped sharply. The housing market gained a bit of momentum as home prices and mortgage rates both declined. The quarter was quite newsworthy, but its major headlines raised some troubling questions about the direction of the markets. On the whole, the economy looked quite good in the fall. Consumer spending increased and retailers benefited from a great holiday sales season. Consumer purchases were up over 5% compared to the same period in 2017. Consumer confidence indices did decline from strikingly high levels, but were still notably strong. How about the jobs picture? In October and November, the average yearly wage growth was over 3%, and the main jobless rate held at 3.7%. Inflation was advancing just over 2% a year by November. The 12-month increase had approached 3% as recently as July. Falling fuel costs helped tame inflation growth, and as a result, the average worker saw their inflation-adjusted income rise 1% in the 12 months ending in November, the most we've seen since 2016. In late December, reports stated the economy had strong expansion in the third quarter. It is not surprising then that in response, the Federal Reserve made its fourth rate move of the year also in December. Top Fed officials' comments fluctuated during the fourth quarter. In October, Fed Chair Jerome Powell stated that interest rates were a long way from neutral, which irritated Wall Street. A month later, he and the Vice Chair Richard Clarida remarked that the benchmark interest rate was close to a neutral level. December's rate increase came with a projection of 2 more hikes in 2019. The U.S. and China did little to address the tariffs they had imposed on each other earlier in the year. At the start of December, both nations did agree to a 90-day truce on introducing new import taxes. Overseas, manufacturing economies in the East and West seem to be decelerating. China's economy slowed in each month of the quarter, reportedly due to reduced consumer demand for goods and services as much as the impact of the tariffs. The European Union and the rest of the world waited for the Brexit to proceed. UK leaders, however, spent the quarter debating if it should unfold according to the deal that Prime Minister Theresa May had presented. By December, May's deal faced almost certain rejection in Parliament. As additional options were considered, the deadline for the Brexit was still set for March 29th of 2019. As bearish sentiment mounted in the fourth quarter, prominent equity indices steadily descended in response. Most major world indices ended the quarter with a negative performance. While equities had a disappointing quarter, some commodity futures posted significant fourth quarter gains. Cocoa, sugar, gold, silver, and the U.S. dollar all advanced over the quarter, while platinum, coffee, natural gas, and WTI crude were among those that fell. While the real estate market cooled off in 2018, the pace of home buying did begin to improve in the fourth quarter. Home sales rose in both October and November. A dip in mortgage rates could have been a factor in the increase. The average interest rate for a conventional 30-year home loan was about 4.5% nationally. It had been 0.25% higher 3 months earlier. The fourth quarter is often hot for stocks, but that was not the case in 2018. Equity investors grew concerned about the Federal Reserve's plans for 2019, the evident economic deceleration in China and Europe, and a narrowing spread between long-term and short-term Treasury yields. The fourth quarter of 2018 was the poorest performing quarter on Wall Street in 11 years. Was the welcomed large cap rebound at the end of December a hint of better times ahead? Earnings season is about to start, and it might be just what the street needs, but before it begins, investors could tread cautiously. Wall Street cannot resume normalcy fast enough for some market participants, but the path towards stability may not be an easy one. The volatility seen in December may take weeks to moderate. 2019 presents investors with many more uncertainties than 2018 did, and patience will be required to contend with them. Patience, in fact, may be an investor's greatest friend this quarter and perhaps even this entire year. At LifePlan, we consider ourselves here to serve you, and we want to ensure that your confidence in your financial plan does not waver as we work together through this volatile period. Remember that your advisor is available to discuss in more detail your questions or concerns regarding your plan and your portfolio. Thank you for the trust you place in us. We look forward to speaking with you at your next conference.